Welcome back to the seventh week of the course Energy Economics and Policy. As we started our discussion on energy market in the last week, this week also we are going to continue our discussion on the same. But unlike the structure that we followed in the previous week, where we discussed more theoretically about the perfectly competitive market structure and monopoly market structure and tried to see whether the features of energy market allow it to be fit in the competitive structure or in the monopolistic structure. So there we discussed several features of certain energy markets, for example, the electricity market and natural gas market and so on. This week, what we are going to do, we are going to follow a little different structure of presentation. We will not start with any theoretical background, but we will start with a little bit of history here. This week we are going to discuss about the oil market. Now, oil market has very defining characteristic. It has a very rich history, and you will see as we go on that the feature of the market, the structure of oil market, it kept on changing from time to time. What makes the oil market very interesting is that from the very beginning, I mean, in 18 mid 19th century, 1859, when commercially, the business of crude oil and oil refinery started, from that time onward, I mean, it took some, 1 decade to build up the industry. But after that, what we see, the oil market was really an international market in nature, right, from the very beginning. And therefore, it observed different international players, different international production houses, how the interplay went on, what kind of influences they had price, what kind of market share did they have, all of this kind of things. It creates a very rich history of formation of oil market at the international level, and that is what we are going to discuss in this week. So in this video, whatever material we cover, they're going to be more descriptive. Later on, we will move towards the analytical parts of the energy market, or more specifically of the oil market. Now, in this week, if you look at the slide, you will see that I have written it as oil market, the pre-OPEC era. Now, OPEC is the Organization of Petroleum Exporting Countries. It was formed in 1960s. And this was the rupture point in the history of oil market. So what we have done, we have divided the lecture essentially into two broad parts. One is the pre-OPEC era, and the other is the era after formation of OPEC. Now in this video, even if you talk about the pre-OPEC era, that is quite long. So that era also we divided in two parts, and in this video we are going to talk about the first era before the OPEC. This lecture is basically based on one of the chapters that I have taken from the book Energy Economics Concept, Issues, Markets and Governance by Professor Subhesh Bhattacharya. This is the book I have been referring in the previous lectures as well. This is chapter 14. It's called International Oil Market. If you're interested, you can visit and you can check the chapter. So most of the material of this discussion have been taken from this chapter. So, as I was saying, that the oil market has a very, very rich history. It has seen lots of ups and downs, very different type of participation of different, international companies and different ways of behavior, different types of margin and acquisition and so on. So we try to divide the phases in oil industries in different parts. So they are not always the most accurate one, but these are some of the very defining era in the history of oil market. So we will start with 1859 when the commercial operation of oil started, and for 10 years or so there was, the period in US is called the period of oil rush. So we will explore each of the periods separately, but I'll just tell you the names at the very beginning. During 1870, the Rockefeller Company came into the picture, and the Standard Oil Company, the oil company that they set up was called the Standard Oil Company, and that was again a very defining moment in the history of oil industry. Then we come to 1911 to 1928. Here, actually, the monopoly of the Rockefeller Company, the monopoly of Standard Oil was towards the decay, and we see some sort of competition arising in the oil market as more number of oil companies participate in the market structure. This went on till 1928. 1928 is actually the era which is called the rise of Seven Sisters. So you will see that when we talk about Seven Sisters, these are the new oil companies that were formed out of Rockefeller Company, or out of the Standard Oil Company. So this was the period where seven oil companies dominated the world market till 1960. So if we look at these four phases, these are the defining phases before the OPEC was established. Now in 1960, the OPEC was formed. We will discuss about the formation of OPEC and the initial years with OPEC. Then we will talk about 1973. We all know that was that was the year where the world experienced the first oil shock following the Yom Kippur War and certain political tension in the geopolitical environment. Then we will talk about post 1975, which also experienced another oil price shock. However, that period was also considered to be a period of demand stabilization. Afterwards, we discuss about multiple phases in post 1980s. Those are a little different. So these are the different phases which are very important if we want to discuss about the emergence and try to understand the structure of the international oil market. So we start with the pre-OPEC era, and as I said in this lecture, I am going to discuss about the first phase of pre-OPEC era. So let us start with a little bit of history. There is a lot of dispute and there is a lot of controversy about who was the first, who was the first one to commercially started digging the oil out of the wells. There are many opinions about this. So one of the most strongest position is that Colonel Drake and William Smith, they operated a well which was situated near Pennsylvania in US, and in that well they actually found oil in 1859, and that was considered to be the first modern well in the history of crude oil. So one claim is that they were the first one to use a drilling process. Before that, it was all kind of digging process that was going on. So if we try to go back a little behind, I mean before 1959, oil was actually found out in the coal mines, and then it was realized that it can be used as a fuel, and then people slowly got interested into it. However, whatever be the beginning of the oil industry in the world, we can see that after 1859, after the Drake and Smith's oil came up, there was a lot of rush to find out whether the land that you are owning at the subsurface level, whether that has oil or not. So people really got interested into it. Now this period was called the oil rush, and it was sort of a private initiative which was going on. Now it was facilitated by the fact that if you look at the law of US, it says that the ownership of underground resources, it was conferred to the owner of the land. So if I have a private land holding, I am also owner of the resources that is there in the underground. So at private initiative, a lot of drilling activities were on. So everybody tried to find out whether there is oil beneath the land that they own. And it was not really, I mean, in terms of a commercial purpose, I mean, the commercial model was yet to be developed, but people could understand that this is a valuable resource which they can have. And the second thing they could also understand, what they wanted to do is that it was a competition among neighbors. So what happens in after 1859? So 1859 to 1870, this for this one decade, there was a lot of activities, private small activities went on towards the drilling and discovering of oil in the land of US, especially surrounding the Pennsylvania region. Now, one need to understand that although there was a rush to find out oil, the technology was premature at this stage. So the technology was not quite able to tell you whether the stock is there or not. It was not very efficient to dig out the oil as well. So although a lot of activities went on, the efficiency level was not very high, and therefore you see what I have written. Given the low rate of recovery, if you look at the third point, so given the low rate of recovery of oil with less technological advancement, it led to high rate of drilling with low rate of recovery. So a lot of investment, a lot of activity, but there was a low rate of recovery. Why was that so? Because of the technology. Also, not enough studies were undertaken to understand whether the oil reserve is there or not. So the initiative was entirely ad hoc in nature. Okay, so we see that there was a oil rush. So there was an supply of oil in the market, if you think in that way. Now, the moment we think about oil market, it's not only supply but the demand also comes into the question. During the middle of this 19th century, the demand for oil was, however, very very limited. You don't have demand for oil from the automobile sector. You don't have demand for oil, for example, from the industries and so on. So this is not a known fuel. So the only use that people could think about of oil was to use them as a lighting fuel. So although the supply was the production of oil was going on in an inefficient manner, whatever supply was there in the market, that was too much to match the demand. So there was an excess supply in the market. Therefore, during this decade of oil rush, we see that the supply of oil is increasing through private ad hoc initiatives. However, the demand is too low, and therefore the price of oil gradually declined over this period of time. So during the oil rush, the market actually experienced high supply, low demand, and therefore a low price of oil. So this is the beginning of the commercial operation of oil. On this, you can say, is the genesis of international oil. I won't say international at this point, but this is probably the genesis of oil market. Let us see what happened in 1870. Now, whatever we have talked about so far, this is basically focused on the production of crude oil. So you take the resource out of out you take the resource out. However, when you get the crude oil is really not the usable form of fuel. So you have to make them usable. That is one thing. Second thing is that you are digging out the oil out of some well, but you have to transport it to other places. So people started realizing that it's not only the production of crude oil, but there are other different businesses, other different production operations which should be, there along with the production of crude oil. And three very important of such, let me just open this thing. Yeah, and three very important such peripheral industries are refining, transportation, and distribution. Now, realizing this fact, that there are other industries than production of crude oil, in 1870s, John D. Rockefeller, the US investor, the US entrepreneur, he actually initiated a business in the line of refining, transportation, and distribution. And this company was called the Standard Oil Company. Now, he was, in a sense, very far-sighted, and he could realize that this, production of crude oil, it involves a lot of investment, but at the same time, it involves a lot of risk as well. So what he, did in a very thoughtful manner, he avoided the risk of production of crude oil, but he actually invested in refining, transportation, and distribution. And this was one of the company which was first company who actually started this kind of a business around refining, transportation and distribution, and gradually they started gaining their monopoly power over the market, whatever small, and they started at a very big scale, right? And we know now from the our previous week's lecture on monopoly that if there is a very big monopoly farm, then it has some automatic advantages, and if it is a natural monopoly, then it's actually not very profitable for other farms to operate. Now this Standard Oil company was so big that whatever small companies emerged around that point of time in order to do business in refining, at the end of the day, they found themselves merged with the Standard Oil Company, right? So the market share of Standard Oil Company became very, very high. So if you see the last point, their share was 90 to 95% in the refining industry in US, giving them the monopoly power and the control over the market price. So this is the typical feature of the monopoly that we know about, right? So if you look at the 19th century oil market, this is basically the oil market in US. US was the producer, US was the distributor of mainly, I mean, US was the producer and the distributor of the oil. However, after 1870, you will see certain other players are coming into the market. But what we wanted to say that Standard Oil, starting from 1870, Standard Oil actually enjoyed a huge monopoly power and huge market share and huge control over price for some decades, right? A couple of decades. So you see, initially for the first 10 years, it was a competitive market structure. There was no barrier towards entry and exit. Suddenly, in post 1870, for few decades, we are going to see some monopoly from the Standard Oil Company. Now, this Standard Oil Company is very, very interesting because today the all the big oil companies that you see, for example, Exxon Mobil, for example, you look at BP. Not BP is not a part of this, but Exxon Mobil, which were earlier Exxon and Mobil, two different companies, and then they merged. They're all, I mean, their genesis are actually in Standard Oil Company, right? So it was bifurcated and then merged and so on. So Standard Oil Company has a very long and dominant history in the in the context of energy in the context of oil market, especially internationally. So till 1911, so 1870 to 1911, the Standard Oil Company was in operation. Although they could not enjoy the entire monopoly power for the entire duration, but they were in operation. What triggered the fall of the monopoly power of Standard Oil Company? This is another interesting bit of history. So far we have seen all the discussions are around USA. So all the the discoveries and all the production of crude oil were mainly in US. Now in 1870, not 1970, 1870 is a very kind of deciding time in the history of oil market. Why? Because in 1870, people started discovering oil in parts of the world other than USA. If you see in Russia in 1872, the oil was discovered in the Baku region in Russia. And the Nobel brothers, they acquired the well and they started transportation of oil from Russia to other parts of the world, especially the Western countries. So the export of oil took place. Another big discovery of oil in 1870 was in the Dutch East Indies, which is now the Indonesia. So there also the operation was started by the Royal Dutch Company and Shell. Later on, the Royal Dutch Company and Shell, both of them, they merged and they were called the Royal Dutch Shell. That was the early 20th century. And when they merged, they actually got a very high market power in the domain of international oil market. And they expanded their operation from Indonesia to other parts, for example, Romania, Venezuela, Egypt, and US as well. So they started selling the oil to US as well. So these are the two very big discoveries of oil, big discoveries of crude oil at that period of time. Along with that, certain other areas of the world also started discovering oil. For example, Mexico came into the picture after a while. In US also, so it's not only the other parts of the world, but in US also the operation was not concentrated near Pennsylvania, but in other parts of US oil was discovered and the operation was started. So two of the big such companies are Texas Oil Company and the Gulf Oil Company. So Gulf Oil Company actually operated in the Gulf of Mexico region. Most of these companies started operation in the global market. Now, this is very important and a very interesting feature with respect to oil. So, all these companies you see, they are big companies. And the moment they entered into the business, they entered into the global market. It's not that they started as a small domestic company and then they become, a player in the global export market. So, from its genesis itself, oil was such a product that it required international transaction, international import and export. And therefore all these companies they became the player of the international market from the very beginning. Again, this backdrop is very interesting. Why is it so? Because now oil is being discovered in various parts of the world. Some other companies are coming into the picture. They are gaining the market share. Now we let us see what happens to the Standard Oil Company. So obviously, when some other companies are emerging, the share of Standard Oil Company will it has to go down. So the importance, the market share, the market power of Standard Oil Company, which had some monopoly power, it started coming down. So this actually weakened the structure of the Standard Oil Company a bit. Later on, in the beginning of 20th century, around 1908 or so, they also engaged in some legal dispute. And finally, in 1911, what happened? The Standard Oil Company was divided into five smaller companies. And the moment you see a big company is divided into five smaller companies, all of these five small companies, they lost their market power, which they used to enjoy as a part of a bigger company. So you see there are three phases. If you see the first phase, the first decade, 1859 to 1870, there was no monopoly. 1870, there was emergence of Standard Oil Company, Rockefeller Company, and therefore you see that they enjoyed a kind of market power, they enjoyed kind of a monopoly power for a few decades. However, the situation was so that gradually other companies came into force and they started operating, and the Standard Oil Company also broke down, and now in the market there are multiple suppliers. So the monopoly structure again breaks down. I'm not going to say that this led to a kind of perfectly competitive market structure, but if you think the market in a scale, perfectly competitive market being in one extreme of the scale and monopoly being to the other extreme of the scale, then definitely during this period, during the early 20th century, the market structure of international oil actually moved away from monopoly towards little bit of competition. Okay. This is what, and these are the reasons what triggered the fall of the monopoly power. Now we will see what happened after the Standard Oil Company was broken down into small five companies. What was going on? What was the scenario of oil? Now, so far we haven't talked about the demand. All we said that in 1859, when the international oil market, or in Pennsylvania the oil well started operating, at that point of time the demand for oil was very very restricted. It was only probably for lighting purpose. However, after few decades, now half a century has passed from that, and people have discovered that there are other very important use of oil. And the biggest one of that was the automobile industry. So there was a demand from the automobile sector, because now the whole structure of the automobile sector has changed. It has become fuel driven, and there was a lot of demand for oil that was coming from the automobile sector in the initial, early 20th century and so on. The second very important thing, in 1914, the First World War started. It went on till 1918. And this during this period, countries who were engaged in the war, they demanded a lot of oil for all their military activities, for transportation, to run the arms and other all other services. There was a huge increase in demand for oil. Now, one may think that World War lasted for 4 years, and after that the demand might have reduced, but that was not the case. This initial part of this initial decade of 20th century, it gave a boost to the demand for oil, and which never kind of declined. It went up and up. So this is the era where for the first time the oil market actually experienced a high increase in the demand for oil. Thirdly, high demand also came for the industries. So transport sector, industries, and the First World War. All these three things, they all together contributed to the increase in demand for oil in the international market. Now, once the demand has been increased, the oil companies realize that they have a scope to increase the supply. Now, oil at that point of time, the discovery and the recovery of oil was going on in a very fast pace. So, if the oil companies wanted, they could actually increase the supply to a great extent at that point of time. So, triggered by the fact that there is an increased demand, they became very, very enthusiastic, if I don't say over enthusiastic, and everybody started producing and supplying too much of oil in the market. Therefore, so they could not understand that they could understand that there is an increase in demand, but probably they were not very clear about the magnitude of the increase in demand. As a result, the supply that they created in the market was much higher than the demand, and leading to a glut of supply of oil during the period of 1928 or so. And the moment again you see that there is the supply exceeds the demand, the price of oil will fall. And this actually led to a crash of price in the international market in 1928. Now, what happens if there is a price crash in the market in 1928? Again, if I kind of take you back to the theory of this competitive market structure, because now the period that we are talking about, there is no longer the monopoly of the Standard Oil Company. So producers now see the producers who are operating in the in the oil market. What happens to them if there is a price fall? So this is the known diagram that you have from perfectly competitive market structure. So what we are saying is that suppose initially, before there was the increase in supply and there was the crash in price, maybe the equilibrium price was P1, and there was some oil industry who were operating at their break-even point if they were supplying their product at the price P1, and Q was the quantity supplied in the market. So they were operating on their marginal cost curve, and they were also operating at the minimum point of their average cost curve, that is the break-even point. Now, the moment there is excess supply in the market and the price falls, let us assume that the price falls at P2, what happens to this well-run farm? That this farm realizes that it no longer operates at its break-even point, because it has to come to a lower point, and if it has to operate at the price P2, it actually experiences some kind of loss in the long run. So it's unable to recover the total cost of production in the short run. It's the price that is getting is actually falling short of the average cost. So it's actually falling behind the break-even point. If this kind of loss continues for a longer period of time, then what happens? This farm actually has to exit the market. So this is what was experienced in 1928. Once the price came down, many of the farms actually had to exit the market. Now again, notice that at this point we are analyzing the whatever had happened at this point based on a competitive market structure, because we don't see any kind of strong monopoly structure at this point of time in the international oil market. So this was a tricky situation, because the suppliers never wanted the price to crash. So they understood that they have to do something in order to check this fall in price. And what did they do? The three big leading oil companies at that point of time, of course, one is Standard Oil, but this is not the old Standard Oil that we were talking about. You remember that in 1911, the Standard Oil was broken into five smaller companies, and one of them was Standard Oil of New Jersey. So Standard Oil of New Jersey, this later on became the Exxon, and now they have become the Exxon Mobil. So the Standard Oil of New Jersey, this is the first one operating in US. The second company, the Royal Dutch Shell, who were operating in Indonesia, and then the Anglo-Persian oil company. They were operating in Persia, that is currently which is Iran. So these are the three main companies who were operating in the oil market at that point of time. They sat together and they discussed and they decided that something needs to be done in order to check this fall in price in the global oil market. So what did they do? They came into an agreement which is well known as the as-is agreement. We'll just explain why is it called an as-is agreement. But this is a very, very important agreement in the history of oil. And you see what is happening here is that as we discuss the points of this as-is agreement, we'll come to understand that probably this is the first sign of a cartel formation by the oil companies in the international oil market. So what is cartel formation? Some dominant players in the market, or some followers in the market as well can be a part of the cartel, and then they come to some kind of understanding about the market share, which is good for all of them. So if all of them stick to the agreement, then it's good for all of them. And the incentive is created in such a manner that if one person deviates from the cartel, then it may not be good for that person and the cartel can break. So let us just have a look what are the major points, what they did as a part of this as-is agreement. So before I go to the points of the as-is agreement, one very interesting thing, and this is often the characteristic of a cartel. Although we are calling this an agreement, there was no written document available. There was no signature that was done. So it's not a written and signed agreement. It was a verbal understanding that was actually negotiated within a group of major players in the oil market in 1928. What did they say? They said that in order to check the falling price, what these companies should do is that not only these three companies but some other companies also joined. For example, the Texas Oil Company joined. You will see many, I mean some 6-7 other companies also joined, and they decided that they are going to stick to the market share, their market share, which is existing in 1928. So that is where the name as is come from. So the market share is going to remain as it is in 1928. So if the market share of, for example, Standard Oil Company of New Jersey is X% in 1928, then in future also it's going to keep it X%. Now why keeping the market share constant is so important? Because you see, when the market realizes that there is an expansion of demand, then each of the oil companies will actually try to produce and supply more in order to increase their market share. If you increase your market share, then you gain some market power. Now this, the initiative to increase the market share is actually leading to oversupply in the market. If you fix your market share and then when their demand increases, all the companies, they sit together and they say, okay, the increase in demand is by, for example, 5%. Then all of us, we are going to, whoever is in this cartel, all of us, we are going to increase the supply in the market in order to suit that increase in demand by 5%. However, our increase in supply will be in such a manner that the market share remains constant. So nobody is going to cheat the other and exceed the market share as compared to what is existing in 1928. So this was the unwritten agreement and understanding, which was understanding that these companies came to. They also agreed to the fact that they will increase the supply when they get a clear indication that there is an increase in demand. So the market will be demand driven, not the supply driven. So when there is an increase in demand, then only the supply will increase. Now, why this particular clause that it should be demand driven has a very strong implication to check the fall in price. Let us look at this diagram. Let us assume this is the initial demand condition. This is, you can think it is a moderate demand condition. And this is the initial supply of oil in the market by the existing companies. So E1 is the equilibrium where supply is equal to demand, and the price that is charged in the market is P1. This is the equilibrium price that is decided. Now, if it is the case that irrespective of increase in demand, or let us say that if it is the case that the supply increases when there is no increase in demand, then what happens? So the demand curve doesn't change. However, I'm increasing the supply. So the supply curve shifts rightward. As a result, what happens? The equilibrium shifts from E1 to E2. The moment the equilibrium shifts from E1 to E2, the price falls from P1 to P2. So this is what was actually happening in the oil market before they came into this as-is agreement. Okay, so this the price falls to P2. Now what they are saying that the supply will increase only when the demand increases. That is, the supply curve will shift from supply curve 1 to supply curve 2, but only if you have a clear indication that your demand has also shifted from demand curve 1 to demand curve 2. Now you see, if the supply was in response, increase in supply was in response in increase in demand, then your equilibrium point doesn't shift from E1 to E2. It will rather shift from E1 to E3, and therefore the price will remain unchanged. So if your supply actually comes in response to the demand, then probably there will be a check on the price so that it does not go down in the international market. So this was the idea behind the agreement that they had. This is this is what we were saying, that if you form this kind of a cartel, probably I will not go into the details of the theory of cartel and so on. So probably it gives you a situation that if all the parties stick to the cartel, stick to the agreement, it's good for all of them. However, if one person breaks out of it, then it's bad for everybody. So that is the idea of cartel in many of the times. So this is a turning point in the history of oil market, the international oil market, this as-is agreement in 1928. Now, one very crucial component or crucial offshoot of this as-is agreement was the Gulf Plus pricing scheme for international oil market. So we will discuss briefly what is this Gulf Plus pricing scheme. This actually stayed for a long period of time, the essence of this Gulf Plus pricing scheme, and then the market moved out of this particular scheme. But this was one of the very important pricing mechanism in the oil market during 1927-28. So if we look at who were the major players during 1927-28, although you will see that during since 1870s onward, there in several parts of the world, oil was being discovered, and you had several suppliers of oil in the market. But if you look at the international market, even in the early 20th century, the two most important players were US and Mexico. So they dominated the oil market in the world, although there were other players. And the price, and since they had a dominance over the market, the price of oil was majorly dependent on the price that was quoted in the Gulf of Mexico, right? So they were controlling the price as well. And there was, it might seem a little illogical, or it might seem a little sort of, I would say, weird, the mechanism of price that they followed, but it had a logic. It says, if I read this third point out, it says, irrespective of the location of the supplier. Okay, so irrespective of the location of the supplier, and the final demand, the price charged, the oil price charged would have been the price at Gulf of Mexico plus the transportation cost to the demand location from the Gulf of Mexico. So no matter who the supplier is, whether you are supplying the oil from Indonesia, whether you are supplying oil from Europe, or whether you are supplying oil from Iran, it doesn't matter. The price that you can charge is actually some base price which is quoted at Gulf of Mexico, which is still okay, plus the transportation cost from Gulf of Mexico to the location from where the demand is coming. So it's not the transportation cost from the supply location to the demand location. It is the transportation cost from Gulf of Mexico to the demand location. Okay, and that was called the Gulf Plus pricing scheme. So the base for the entire pricing scheme was the Gulf of Mexico. And this could happen because of the kind of dominance of US and Mexico in the world oil market at that point of time. This will become a little clear as we go into this explanation. So if you look at this map of the world, here is Gulf of Mexico. So, okay, so here is Gulf of Mexico and here somewhere we have Iran, right? Now let us assume that we need to supply oil to Brazil. Okay, now if I have to supply oil to Brazil, given the Gulf Plus pricing system, what do we have? If I am supplying it from Gulf of Mexico, then the price charged will be equal to the price quoted at Gulf of Mexico plus the transportation cost from Gulf of Mexico to Brazil. Okay, this is the price that will be charged if the oil is transported from Gulf of Mexico to Brazil. Now there is no problem in this because it includes your transport cost, it includes your cost of production, the price includes the transport cost, it includes your cost of production and so on. However, if Iran wants to supply oil to Brazil, then what happens? It gets the quoted prices at Gulf of Mexico plus the transportation cost that is required to cover only this distance between Gulf of Mexico and Brazil. Now see, the distance between Brazil and Iran is much higher as compared to the distance between Gulf of Mexico and Brazil. So essentially what we can say that the transport cost of Gulf of Mexico to Brazil will be much lower than the transport cost of Iran to Brazil. So if the price only recovers the transport cost from Gulf of Mexico to Brazil, then Iran is actually losing in terms of non-recovery of some of its transport cost. Okay, so essentially what is happening, Iran had to pay an extra cost to supply oil to Brazil, which is close to Gulf of Mexico. So if any country wants to supply oil to some location which is close to Gulf of Mexico but not so close to the supply location, then they are in a disadvantageous position. Okay, if you do that, actually what happens if you do that, you ensure that in the neighborhood of Gulf of Mexico, in the neighborhood of US and Mexico, the dominance or the market power of US and Mexico as an exporter will remain unchanged. So if Iran, can't recover the transport cost if they supply to Brazil, they would rather not supply to Brazil. They would allow Gulf of Mexico to supply to Brazil. However, this is one part of the story. The other part of the story is that through this price mechanism, countries in the Middle East or countries which are, far off from Gulf of Mexico, they can gain something as well. What is the gain? This is the loss that they're incurring out of the Gulf Plus pricing scheme. Now, what can they gain? If you see a location which is closer to Iran, right? For example, in India, if Iran wants to supply oil in India, what is the price that is they going to get? Iran will get the price which will be the quoted price at Gulf of Mexico plus the transportation cost of oil from Gulf of Mexico to India. So in this case, what is happening? In this case, in order to transport oil from Iran to India, which is much less expensive as compared to transportation of oil from Gulf of Mexico to India. However, when the price of oil is calculated for Iran, it takes into consideration this long distance and a high transport cost. So, if Iran is supplying oil to a country like India, which is close to Iran but far off from Gulf of Mexico, then Iran actually gets a fictitious charge to supply oil to this kind of locations. So ideally, the situation is that if a Middle East country where you are newly getting the oil, if a Middle East country wants to supply oil to a location which is close to Middle East but far from Gulf of Mexico, then they are earning some fictitious charges. So they are earning some fictitious benefits. However, if they want to, supply oil to a part of the world which is not close to Iran but close to Gulf of Mexico, then they lose in terms of freight or transportation charge. This is called the parity. This was idealized as a parity. So if you one kind of nullify the other, so if you supply oil in different parts of the world, for some part you lose in terms of freight, and in some part you gain this fictitious charge. Overall, things get nullified and a parity is being set up. That was the idea behind it. But you can see that this kind of price mechanism is possible only when US and Mexico, they have some market dominance. Let us look at this diagram, which will make things a little more clear about the Gulf Plus pricing mechanism. The maths looks like this. It's very simple. Suppose there is a geographical location J. Okay, so at this geographical location J, the price of oil that is being charged to this country is called PJ. So this PJ will have two components. One is P1 plus a DJ. Okay, what is P1? P1 is the price quoted at Gulf of Mexico. So this is the price at Gulf of Mexico. This is the base price. Okay, let us say this is the P1. Okay, the base price. What is A? A is the unit cost of transportation of oil. What is so this is the unit cost of transportation oil. Now, if the location where things are to be, or where oil is to be transported, if this location is situated DJ kilometers away from Gulf of Mexico, then the total transportation cost is A multiplied by DJ. So at any geographical location, irrespective of the location of the supplier, the price of oil would be equal to P1 plus A multiplied by DJ. So you can see, as the distance from Gulf of Mexico to the location of demand increases, the price also increases, irrespective of the location of the supplier. So this is the price. PJ will be equal to P1 plus A multiplied by DJ. This is also referred to as world parity price for oil. And why parity? Because I explained, right? For some cases you are losing in terms of freight, for some cases you are gaining the fictitious charge, and therefore there is a parity which is reserved. Now this diagram actually makes it very, very clear. See, I have taken two locations, right? So this is the Gulf of Mexico and this is Middle East. And if you start from here and go to your right, this actually shows you the distance from Gulf of Mexico. If you start from Middle East and if you move towards your left, that shows the distance from Middle East to the location where you want to supply. And this P1, as I said, this is the quoted price at Gulf of Mexico. Now, as you move away from Gulf of Mexico, if you want to supply oil to some area which is farther away from Gulf of Mexico, this is how the price increases. So the distance between this dashed line and this solid black line captures the transportation cost. So now suppose Gulf of Mexico wants to supply oil to some location B, for example Brazil, which is close to Gulf of Mexico. Then the price that is being charged to Brazil will be BD. Okay, so starting from here up to this line. So up to this broken line, this is P1 and this is actually A multiplied by D. So the slope of this line is actually A. If Gulf of Mexico wants to supply oil to point C, which is far off, then this is the price that will be charged from India, EC amount of price. But whether it is far off or whether it is close, the price is covering the actual transport cost. So there is no problem. There is no fictitious charge or there is no payment of freight from their own pocket for the Gulf of Mexico. However, the trick comes here. If you are supplying it from the Middle East, you remember that this is the Middle East, and as we are moving left, we are going farther away from Middle East. So the distance between the Middle East country and the the demand location actually increases. So if you supply from Middle East, then actually the cost of supply increases along this line. So as you go farther away from Middle East country, your cost of transportation increases along this line. Here also the absolute slope of this line is A, and the distance between this dashed line, broken line and the solid line is actually A multiplied by dj. So this distance is the transportation cost. So this line captures the actual cost that is incurred by the Middle East countries in order to supply oil to different locations in the world, right? Now see what happens. Now suppose this Middle East country, they want to supply oil to Brazil. What is the price that they are getting? They are getting the same price as the Gulf of Mexico getting. So the price that the Middle East is going to get is again BD. However, the cost that they are incurring is more than BD. The cost that they are incurring is actually FB. So this FD difference, this is something which they are unable to recover through the price mechanism. And this FD part is actually the freight that this Middle East country has to bear from its own pocket. So this is the freight to be absorbed by the Middle East producers. This is the loss for the Middle East producers. However, the same Middle East producer, when they are supplying to India, then what is happening? You see, the price that they are charging, that the price that they are getting from India is actually EC, same as whatever is getting the Gulf of Mexico is getting. But what is the cost of supply of the oil? The transportation cost is much lower in this case. In this case, CG would actually, this is G, so CG would actually represent the cost of supply of the Middle East country to a country like India. However, the price that they are getting is higher than the cost of supply, and this gap represents this difference between the cost of supply and the price. So this EG part, this is actually a fictitious charge which is again being absorbed by the Middle East countries. So this fictitious charge is a gain for the Middle East country, and this freight that they are losing, this is actually a loss for the Middle East countries. So this shows that the Middle East countries, or this is an example, any other country for that matter, would actually be reluctant to supply oil which is farther away from their supply location but close to the Gulf of Mexico. So this is the mechanism through which US and Mexico kind of secured their neighborhood zone where they are exporting oil. So this is where we are going to stop in this lecture, and in the next lecture we will continue with this, and we will talk about what happened in post 1928 era. Thank you.